I want to thank everyone for joining us today from across the country and around the world. I am Michael Higgs, Virtual Program Manager here at Conscious Capitalism. And on behalf of the whole CCI team, we do appreciate you taking time to learn and grow in community with us. Today, we're excited to be sharing space with Roosevelt Giles. He's the chairman of the Stakeholder Impact Foundation, and he's a member of the board of directors for Just Capital. As many of you know, Conscious Capitalism is a global community of CEOs, presidents, founders, board members, entrepreneurs, and thought leaders from diverse industries and backgrounds and perspectives who are committed to the shared purpose of elevating humanity through business. Founded in 2008 as a 501c3, CCI provides our community of active operating leaders a platform to share practical advice and tools on how our principles are integrated into different organizations within various industries. Our community of conscious capitalists offers best practices and business strategies on how the philosophy is applied to create sustainable success within one's business, leading to systemic change and impact in the world. Several times a month, we offer virtual gatherings like these as a way for our community to see how the philosophy takes shape in the leadership journeys and business practices of those in our network. Just a few housekeeping details before we get started today. We're going to run our session for about 45 minutes. Roosevelt and I will be in conversation for about 25 to 30 minutes, but questions are certainly welcome throughout the presentation. So if Roosevelt shares something that is thought-provoking or generates a question, get it into the chat because we want to get to it as soon as possible. We are going to save a portion of our time together for a official Q&A, which will be the last 10 to 15 minutes. But to tee up today's conversation a little bit, the role of the board, it's never been more critical or complex. There's public scrutiny, heightened accountability, and a need to provide strong leadership. These all necessitate a strategic and well-honed approach to board stewardship. But questions arise: what qualities and strategies contribute to an effective board? And of course, central to this discussion is the importance of experience. Prior experience fosters a deeper understanding of board dynamics and best practices. But how does someone transition onto a board effectively? A high-functioning and forward-thinking board will ensure that it's equipped to address issues proactively, integrating complex considerations into strategic planning and decision-making processes. In today's virtual gathering, we hope to share and provide some insights on how to build strong relationships among members, how to cultivate trust and open that communication with the CEO and senior leadership. Additionally, how to foster focused discussions for maximizing board productivity in today's ever-evolving landscape. I do want to just give a little background on Roosevelt. He has over 35 years of experience managing domestic and global strategic and operationally complex operations. He's the founder of Endpoint Ventures. It's a holding company with investments in over 13 companies. He holds several board positions, including chairman of the Stakeholder Impact Foundation, former chairman of the board of Atlanta Life Insurance Company, former chairman and board of heightened Capital Management, REI, with 10 billion under management, former chairman, IMS Asia and IMS Africa, board member, Tabi Inc., advisory board member of NASDAQ Board of Excellence, Just Capital, chairman of the Business Insurance DEI Council, chairman of GHI Holding Healthcare. He holds a BS degree in business administration and studied at the University of South Carolina, Limestone College, and he also has advanced management courses from Harvard and MIT. He's run over 370 marathons, including 50 in the United States 4 times. He has run on all 7 continents, yes, including Antarctica 3 times, and a marathon in 53 countries, which was at the request of his brother, James Giles. Without further ado, a warm welcome to Roosevelt Giles. Thank you so much for being here, Roosevelt.
Thank you, Michael.
Yeah, delighted to have you join
It's
us.
definitely a pleasure to be with Conscious Capital and the work that Conscious Capital is doing and what Just Capital is doing is phenomenal to
Wonderful.
get.
Well, I want to jump in. Let me just take a quick look at chat. Let's see. Yes, we have. So we do have some board members with us. Fantastic. Greg, nonprofit. Do Sway is in the process of building a conscious benefit corporation. Um, let's see. Charlie is just forming a board. Well, fantastic. Everyone is bringing a unique perspective to the conversation. I kind of want to jump in really quickly because this is a new topic for me, Roosevelt. Let's just kind of do a board 101. What is corporate governance and why is it important?
The Well, when you look at corporate governance, it's all about the rules of engagement.
Mm,
The rules of engagement around how you're going to manage and oversee and manage the risks
mhm,
of a company. Okay, that being a private company, that's a nonprofit company, or a publicly traded company, is what governance is about. It's about coloring between the lines, okay, of this legal entity and not doing things that's going to impact the short term or the long term viability of that organization. That
mhm,
is key.
mhm. Okay. Okay. And then just as a follow-up, what are some of the benefits of good corporate governance when we see it when we see fantastic corporate governance on display, or we hear about high functioning boards? What are some of the benefits of that?
Before I answer that, what I like to do is for you to pull up
In
slide here. I want to bring up
indeed,
Milton Freeman.
yeah,
So
indeed.
that will guide us down that path. Start us down that path.
Yeah. Let me
The when
hold on.
you look at here, you know, what is a company, what is governance, what is a board, and how boards function and how they work, and how does one go about getting on boards and things there. So if you look at here, Milton Freeman, the doctrine is pretty much the godfather as it relates to, you know, what a company is and the residuals from a company, who should be the recipient of that. And that
Mm,
recipient has been a shareholder primacy theory, for a long, long, long time, over 40 years and things there now. And so you look at this, the fact that Milton Freeman says that a business is to increase profits. The shareholder primacy approach views shareholders as the economic engine of the organization and the only group to which the firm is socially responsible. Think about that. The only stakeholder that the company should be concerned about are the shareholders who put up the capital, okay? And so therefore, they should get first dibs. They should be in pole position as it relates to residuals of the organization. Now let's go to the next slide. Now, when you look here, who owns the company? You want to govern this thing. You want to manage it. Who owns the company?
mm,
And I think a lot of people will say the shareholders. I have 10 shares of stock. I got 1 million shares. I got 500,000 shares. So the shareholders own the company. And so therefore the company should act in the best interest of its shareholders. Is what it should do. And any profits and things that's generated in that company, shareholders should be first in line. That is not true.
mm,
Shareholders do not own the company. Let me repeat that. Shareholders do not own the company. The a company is a legal human being. It's what a company is. A company can live in perpetuity. It can create new companies. It can bring on debt. All right. It can borrow money. It's what it can do. And so, therefore, when you look at this, you can't own a person. You can't do that. So, in the law of a corporation, I am a person. Shareholders don't own me. You have a residual, okay, right to the proceeds of the company, and you only have that right only when the board of directors agree to pay you a dividend. That's it. And so, and this is where the concept of shareholder primacy, okay, came into play, where companies and directors know this, all right, but they sort of shy away from it. And so shareholder primacy has prevailed. My only job as the board of directors and overseeing and managing the risk in this organization with the CEO and the management team is for the benefit of the shareholder, period. No one else, not the community, nothing. Couldn't be more wrong. Shareholders not owning the company, that rests in the hands of the board of directors. Now, if the company becomes solvent, then yeah. But outside of that, the board of directors determine when dividends will be paid, and the shareholders have absolutely nothing to do with that. Now, when you look at this slide here, you see widely held retail shareholders. And where I'm going with this is that where the power relies, because shareholders do have power, they vote. In the slide, you see the voting power pushed down to the board of directors. Shareholders vote for the board. They vote the board in. The board in turn has supervisory powers over management. They hire and fire the CEO. The board also owns, along with the management team, the strategy of the organization. Okay. And to ensure that the strategy of the organization is a strategy in such that the company can sustain itself. All right. And that strategy will change over time based on market conditions and customers' tastes and preferences. All right. That's what's going to happen here. So therefore, the directors have that supervisory power. And now you have these tentacles that spread out into the capital markets for capital, marketplaces for your customers, and all of those. All right. So again, this slide here is the starting point of shareholder primacy, is what it is. Now, let's go to the next slide. Today, let's look at governance today. You notice here, there's a few more blocks, a few more names, a few more labels. All right, that's what you see. Historically, companies have lived in a compliance governance model. What do I mean by compliance model? I'm compliant with Sarbanes-Oxley. I'm compliant with PCAOB. I'm compliant with the SEC. I'm compliant with all of the regulatory bodies that governs my industry. And in that model, board members spent most of their time in hindsight and oversight. It's where boards spent a lot of their time. And so boards wasn't focusing a lot of their time on foresight, where the puck is going, where the market is going, where the customers are going. So most of their time was set in those two realms of governance. When you look at today, here today, what you have is that you have the security markets, you've got shareholders, but companies moved, okay, from an employee standpoint, a lot of their pension plans into defined pension plans. And those plans went into 401ks. It's what those plans, those dollars went into to save for your kids' college education and retirement. And those funds went into what you call index funds. all right? The BlackRocks, the State Streets, the Fidelities, the Vanguards, Wellingtons, all of those, all right? It's what those funds flowed into. And those funds flowed into the market, which removed me as pretty much as a retail investor in the compliance governance model, where the power was with the directors. Now, today, the power is with the index funds, the BlackRocks, the State Street, the Fidelities, et cetera, et cetera, et cetera. But you see the security markets here, the shareholders being index funds, trillions of dollars from the index funds, flows down to the board of directors, and now where the voting power resides. The voting power resides with the institutional investors who are the index funds. It's where it resides today. And the index funds have concentration power. They own a very large percentage of the S&P 500. Is what they own. They also specify governance guidelines that they specify on how companies, how board of directors are voted in, how they stay in, and what of the guardrails that companies, boards should adhere to. And if they don't, they can be voted out. Again, no different than if I was a retail, the investor. You also see here private equity, hedge funds, those are also heavily invested in a lot of these firms. And so when you look at a company, you can see that this company now is managed by a board with the constituencies still being capital markets in order to tap capital, employees. And you also notice on the employee side of the house, talent today is a what? That's a huge, big, big asset for the organization. Because today, in this governance world today, the value of companies happens to be intangible assets, not fixed assets, like in that compliance governance model, plant, equipment, and all of those. Today is all intangible. And so if you look at the S&P 500 today, over 80% of the value of the S&P is all intangible assets, intellectual property. So who generates that intellectual property? People, talent,
Right.
the talent wars. And so boards now have to be involved with one of the most important assets to increase that value of intangible assets. The boards have to have oversight on that. They have to have foresight on that. It's what they have to have now. And that's why you're seeing lots and lots of print, lots and lots of zeros and ones around talent and the ecosystem that is built up around that. But you still also have a lot of these disparities as it relates to talent, especially when you look down in communities and also externalities. In companies today, a lot do not capture the true cost, okay, of their products, what it takes to make their products. Because what happens is that they externalize part of that cost out in the community. It is not captured on their balance sheet. It's what it's not. And that has caused a lot of disparities in the world. It's what that has caused. Because that's why pay equity, gender equity, financial wellness, the work that Just Capital is doing, the work that Conscious Capital is doing to get the boards, the board of directors here, to understand that in order for a company to survive and to sustain itself and to be able to outlive a human on average, boards have to take into account all of their stakeholders, not just the shareholders. And I know some people will debate the fact that, corporate law dictates that boards are mandated to for shareholder primacy. That is not correct. Boards have leeway. It's what they have. Now, if you don't do your homework as a board, yes, you're going to be in trouble. You will get sued, etc. Is what you will do. But you do have leeway in how boards can provide a return to the people, shareholders that put up the capital. Because I am a welder. My money is sitting in Vanguard. I want Vanguard, the funds in my account at Vanguard, to generate a decent return so my kids can go to college and I have funds to retire on.
Mhm.
The basics. That's what they want. That's all they want. And so the companies have to be managed, there as such. But when they are not managed, that's where you see PE, private equity, hedge funds come into play. Where those companies go and find the weakest links in the herd. Who are the weakest in the herd of these companies? And they go and pick those companies off. They go and buy those companies. And now those companies go dark in the public markets. You have no visibility into those companies all because now they're private. And so, and those funds are growing. They are getting big, almost to the tune of the size of some of the index funds. And they're buying not just companies that are distressed, but they're buying profitable companies because they've got trillions of dollars of dry powder is what they have to work with. It's what they got. And so when you look at, again, corporate governance today, as a board member on a publicly traded company, this is the diagram and the risk that you are coming on board to manage. You have to manage the markets, the analysts. You have to manage those shareholders because you still have retail shareholders as well. You have to manage the relationship with the index funds. It's what you have to manage. The communities. And also you have today activist investors. Activist investors are going after not just, again, troubled companies. They are looking at, again, what areas in this profitable company that management and the board is overlooking, that they're not seeing in the marketplace. So they will now launch an activist campaign against that company.
Mhm.
The activists also are trained on now the composition of the board and the competency of the board. And now companies are now having to shore up the competencies, the types of skill sets and things that are needed on the boards today. And that is driven not only from the marketplace, but it's also driven heavily for activists. And in today's market and in today's world that we live in, this digital world we live in, every company today is a technology company. It's what it is. And yes, you got 80% market share today or 70% market space in a product line. That's fleeting. That can change overnight. Why? Intangible assets, intellectual property. All right, is what can happen. And that's why companies today have to have skill sets on the boards that understand not only where the puck is going, but also understand the value that intellectual property encompasses. And that's data. Every company is a data company. How do you manage that valuable asset? How do you do that? How do you safeguard it? What's the risk around that? That was not the case in our earlier model of compliance governance. Didn't even come into play. And today, this is table stakes. You didn't need technology people on the boards. Why? Because of the fact, well, we viewed them as one specialty, okay, skill set. We don't want just one specialist skill set. Well, today you're going to have specialist skill sets on the board because you can't take all of this that is sitting. If you take a look at this slide too and sit on the bottom, or sit on the top, audit committee, risk committee, nomination and governance committee, you might have another one sprinkled in like risk. They can't handle the load.
Mm,
They can't handle the oversight. They can't handle the foresight. Okay. And so therefore, companies are going to have to create additional committees and bring on additional different skill sets to be able to manage this complexity today. Is what
mm,
they're going to have to do. Now, this doesn't take into account the global markets. Lots of companies are global. It's what they are. And now, not only having you deal with the institutional investors and the index funds around domestic, what about the sovereign wealth funds on the international front and the private equity firms on the international front and the regulatory environment on the intellect and on that front as well. So again, you start to see here what is corporate governance is somewhat very difficult to define. It's, and those out there that want to go on boards, go ahead and go on a board. Why should you be happy? You know?
Well, one thing to note, yes, is this third slide is much more complex than the previous. I do want to jump to a few quick questions.
Yes.
Uh, I just want to circle back on what is the incentive for the activist as they're going after these companies to highlight an area that maybe there's been um oversight on from the board of directors. Is it financial or is there another incentive for activist investors?
Well, activists are in business to make a profit, right?
Mhm.
That's what they're in the business for. And they're not the Girl Scouts or the Boy Scouts is what they're not. And what they do is that they go and target a company and again look at where the weak spots are in the governance, in the strategy of the company, in
Mhm.
the composition of the board is what they go and take a look at. And then they will place a call to management. But prior to doing that, what they'll do is that because they have relationship with the index fund, the Black Rocks, the State Streets, there, etc., um, other funds, they will go and talk to them and to see how they view, okay, the company. They'll look at all the analyst reports and all of those types of things. And before they place that phone call to you, Michael, they have analyzed your company.
Mhm.
And so when they place that call to you, they're not asking you about your strategy. They already know it. But they burned up their Bloomberg terminals analyzing your company already. So you don't need to tell me about nothing about your company. What you have to tell, what I'm looking from you, from the company, is your attitude and your tone. It's what I'm looking for.
Mhm. Mhm.
All right. And so companies, if they don't have a activist strategy in place and a plan in place, they are not doing their fiduciary duty. It's what they're not doing.
Mhm.
They should have that plan in place. All right.
Mhm.
On the shelf is what they should have. But the other part here is that they're going to go through your filings and pick out a couple of weak points where they will now go and have a conversation with you.
Mhm.
And if they feel like that you are not being forthcoming, then they might launch a campaign. A
Mhm.
lot of these campaigns from activists, they never hit the public wire, so you don't know about it. Also, companies shouldn't be as surprised by an activist because they can look in their stock registry to see if an activist is sitting there now. It's,
Mhm.
it's part of our ownership structure on the equity side. And if so, that should be their warning. That's a
Mhm.
warning sign. That's a shot across the bow. We have an
Mhm.
activist in our stock registry. It's what we have. And so now we should play activists internally. Okay. We will play activists internally to see where we might have gaps. All
Mhm.
right. And we can go ahead and fill those gaps in. And so now that would buffer, the activists coming in and also not allowing the activists to go and form alliances with other activists to create a wolf pack all right, and come after the company.
I want to go back. So you had mentioned that one of the ways to address the maybe knowledge gaps or gaps in specialization on boards is to bring on committees, right? And when you were talking about intangible assets like data, I know that there's a real need for cybersecurity specialists, for example, to protect that intangible asset that a company has. When we look at more an increased complexity in the number of board members who are specialized, and then we look towards senior leadership, CEOs and such, when you've got a lot of specialized people focused on specific areas, how do we build that trust between senior leadership when you've just got more people in the room with unique skill sets that are closing those gaps that the organization has?
Well,
I
well,
want, I
number
want,
one,
I
you
want to
might want
really
to order.
surface that trust piece on how to bridge between board and CEO and senior leadership.
Okay, great, a fantastic question. Number one, you're not going to have 20 committees. Okay, you're not
Mhm.
going to have 20 board members. Is what you're not going to have. But you'll have board members and CEO that'll say, all of our 100,000 associates around the world sends you greetings, right? Do CEOs not do that? All my 50,000 employees send you greetings, etc. But boards are so reluctant to expand the number of board seats
Mhm.
because they'll say, well, it's difficult to manage.
Mhm.
So having 9 board members or 11, that suffices. Well, that suffices in the compliance governance arena. It does not apply here in this stakeholder governance arena because of all of the complexity. And again, where do we sit on the value of the company? Intangible assets.
Mhm.
So having specialized skills will be a requirement.
Mhm.
Boards today hire specialized consultants every day. Every day. It's what boards do. So why not have 1 or 2 specialized directors? I mean, they understand finance, they understand strategy and things. I'm a technology person. I understand strategy and things there, and how you go about engaging customers and all of that type stuff. I understand those things. And so those individuals will learn over time. It's what they will learn. The other thing why we need this change in board composition, the shareholder stakeholder debate can start to move forward by having individuals with these different skill sets, Michael,
Mhm.
because the predominant skill set in the compliance arena, you had to be a CFO, you had to be a COO, and you had to be a CEO. It's what you had to have. Now, how are those individuals compensated by the board? Short-termism, the quarter. I got to make the quarterly number. All right. It's what I've got to make because that's what I'm incentivized to do. That's also what my own compensation package is based on what the share price is going to be because that's what I'm incentivized to do. The
Mhm.
board has incentivized me to do that, and I'm darn well going to make that number in that quarter. If I have to cut the marketing budget, if I have to, delay that IT project and things, I'm going to do it to make that number. And
Mhm.
most of the board members will never see it anyway. All right. At that level, they will never see it. So we need, Michael, we need those at that additional skill sets who's going to ask these 2 important questions that will
Mhm.
send shivers up a CEO's spine. Why and how do you know? Those are the 2 most important questions a board member need to ask management. Why and how do you know? And you need more of that. Because when you talk about diversity, we're not talking about, ethnicity here. We're talking about diversity of the skills. Because having just CFOs on the board and CEOs on the board, what do you think you're going to get? The skill sets are all the same. All the same.
Mhm.
So you need that diversity of those skill sets is what you need. And also having that diversity skill set will now, who didn't grow up in that what? Shareholder primacy arena. And I got to beat that quarter. Now we're going to do what? We're gonna manage for the long haul, for the
Mhm.
long term, for all of our stakeholders. We're going to look at the true cost of our of doing business. We're not going to be externalizing costs out in the communities. Is what we're not going to be doing. We're going to pay our people. We're going to give them benefits. Is what we're going to do, so that therefore we can be good stewards and help build communities. All right. And the only way you build communities is for people working for your company to be able to have above a living wage so that they can make investments in the local businesses in which they live.
Mhm. Amen. Um, I do want to, I know we have a couple minutes left. I do want to,
You can take the slide down. You can take it
okay.
down.
All right. If any questions have surfaced in today's conversation, that slide, thank you, Roosevelt. That was very thought-provoking and one that I'll go back to look at over again to kind of understand. Yeah, Jewel, I agree. Masterclass overview. Rarely does one slide kind of articulate the complexity of such a topic, but beautifully done, Roosevelt. One question I had is, we have we're heading into an election year. There's a lot of divisive issues that are being surfaced. There's pressure being put on companies to respond to various topics. Do you have a point of view on how companies kind of navigate this election season?
One of the things I would ask the audience to look up is a ruling by the Supreme Court back in 2010 called Citizens United.
Okay.
Citizens United. And prior to Citizens United, corporations could not use the treasury of the company, the shareholders' money, i.e., to fund campaigns, political campaigns. They couldn't do that. That was illegal. You could not do it. And so the CEOs or the board members or whoever, they would have to go and use their personal funds and go and make donations, is
Mhm.
what they could go and do, but not the company. But with the passage of the Citizen United ruling by the Supreme Court, it gave unions and corporations the ability to spend unlimited funds
Mhm.
with political action committees and things for political candidates.
Mhm.
All right. So, to your point, if I'm the chair of the banking committee and you are a banker, CEO of ABC Bank, Michael, and I come to you and say, Michael, I'd like for you to do a fundraiser for me, and I need to raise $2 million. Now, keep in mind, I'm your regulator. What are you going to do, Michael? You're going to go raise $2 million. It's what you're going to do.
Right.
It's what's going to happen. Uh, and so this is where we are today. That ruling really, really put good candidates that don't have the oversight, regulatory oversight,
Mhm.
country club oversight, partnerships to have access to those funds. They don't have it. And that puts our elections, it sort of skews things.
Mhm.
And that's why incumbents can generally stay incumbents because they have the money. They have access to the money. It's corporate money, is what they have access to.
Mhm.
And that's a problem. To your point in regard to legislation, all of the legislation you're seeing around ESG, bad words, DEI, bad words, all of those things being bad words. Well, who am I supporting as the CEO of the company in the board room? Go take a look. You can see. And a lot of those issues that they're promoting is counter to what the employees
Right.
of the company. And so now what you have find is the fact that now the employees left is on this side and right is on this side, red and blue. And you walk into the, to the cafeteria in the company. That shouldn't be. That should not be. But that was terrible. Citizens United was terrible. But when you read that, that'll tell you a lot about where we are today politically. And that's why we've got a lot of backlash around still shareholder primacy supreme. All right. We pay salaries so employees can go and give to churches. They can go and give to the YMCA. They can give to American Red Cross. We pay them salaries. All right. But we don't pay them enough salaries for them to just make it to the next pay period. They have to go see payday lenders is what they have to do. Well, you're not paying your share of taxes, right? As a company, you're avoiding that. So therefore, now we have to raise the millage rate. We have to raise the sales taxes. And schools can't get all the support they need because of the tax base, okay? And now my property taxes and things go up.
Right.
And so you see this trickle effect where these things has consequences, all right? It's what they have. And so again, that ruling changed everything. And that also contributed to this political divide that we have today.
Okay, I did put it in the chat. Citizens United recommended by Roosevelt to review, take a look at. I want to jump to a question here, Roosevelt, from Charlie. He says, if possible, can you discuss the differences between corporate board of directors and an advisory board? And when does a
Corporate board of
company,
directors advisory board, yes, definitely.
yeah, and when
Okay.
does a company implement each of these types of boards?
Yeah, great, fantastic question. When you look at a corporate board, be that private or public board or nonprofit for that matter, the corporate board means you have a fiduciary duty. You have a legal obligation a duty of care and duty of loyalty, meaning that you're going to do everything in your power possibly to be prepared, to do the work, to ask the right questions, and hold management accountable. All right, that's what you're going to do. And the duty of loyalty, where you're going to put the interests of the organization first and not your own interests. All right, what you're not going to do. When you look at from an advisory board perspective, advisory boards have been around forever, and you mostly see advisory boards on nonprofits. You have your fiduciary board members on the nonprofit, and you have advisory board members. But that is something that you don't see on the corporate, all right, side of the house. But we have been, in our program in Stakeholder Impact Foundation, have been working with companies to implement in order to accelerate getting new talent in the boardroom, and also having companies to look at putting an advisory board, 1 or 2 slots on their board for succession planning. All right, is what they can also use this for. An advisory board person is sitting on a publicly traded company board or a big private company board. They don't vote. They're assigned to the respective committees. They go to all the board meetings. They participate as a normal board member, and they get compensated for that. And what that means is the fact that a companies now can bring in these advisory board members, 1 or 2 slots on their board, with the skill set deficit that they need on the board. And now it gives them access to talent that they ordinarily would not have access to. And they can do this from the standpoint of, let's say that slot is for a 2-year term. Well, now you can bring in a couple of these skill sets for 2 years. You see what they can do. Now you might have an opening that come up and on the board, then they can apply for that. But the other side, now that they have been on your board for that couple of years, they now can get a board seat on ABC Company as a fiduciary board member. So this gives companies the zero risk. There's absolutely no risk in doing that and putting an advisory board slot on that board, bringing those skill sets, and now it gives you a lot of flexibility in what you do. And this is one of the other things that activists are going after companies, again, like I said earlier, on the competencies of the board members and board succession. Advisory board concept is the way to do it.
Wonderful. First, I want to acknowledge we've gone a few minutes over. Charlie, thank you for your question. Roosevelt, I want to give you an opportunity to just share your work at the Stakeholder Impact Foundation for the benefit of the audience, what you're doing there, and how people can learn more about that.
Okay. Yeah, Stakeholder Impact Foundation, what we do is that when you look at this shift that I've been speaking about around shareholder primacy and stakeholder primacy, something has to change. The diversity of the skill sets in the boardroom has to change. And so we developed a 4.5-month, 5-month board readiness program that we take all stakeholders. Everybody is invited. And this program is tuition free. And we take them through the rigors of this 4.5, 5-month program on how to be a board member and the gory details, the good, the bad, and the ugly of being a board member. Things such as each fellow gets assigned a publicly traded company. That's 30 modules. There's 17 case studies. All right, that's what it is. And you have to present your publicly traded company case with the audit committee, compensation committee, strategy, technology, all of these various modules that we teach. The other part of this is that at the end of the cohort, the fellows have to put together a SWOT report of that company, and it had to be defended to a 3-person defense committee, similar to your dissertation or your thesis, right? And we will then in turn give that report to the company. The company has no idea it's coming. They have no idea. And the whole premise here is the fact that by advancing that report to the company now will see the research associated with this individual, the thought leadership thinking of this individual, and now may consider adding a advisory board slot or adding them as a fiduciary down line. The other part of that, we all know all of these companies have what? 9 or 11 board seats sitting around the table. Now that fellow has been introduced to all of those board members. In essence, now 10 or 11 companies is what they've been introduced to. So, our premise is to, and when you look at conscious capital and you look at just capital, I look at us as being in the center. Well, conscious capital is speaking to leaders, CEOs, board members to say, you need to consider, okay, all of your stakeholders in order for your business to be sustainable. Your business cannot be sustainable in the shareholder model. In conscious capital, in its affiliation and meeting with various companies to help them to understand that this is good for business. Just capital approaches it from financial wellness on the worker side, so that being that intersection between management and the workers to rebuild the trust. Because when you look at capital allocation, there's 3 buckets: financial capital, okay, social capital, and human capital. Those are the 3 buckets for capital. And when you look at what we're doing between the 3 organizations, we are building the bridges to bring social capital, human capital, financial capital, so it works for everybody.
Roosevelt, I just put in stakeholdergovernance.institute.com into the chat. I see Jules very excited. She says, this is unreal, free. I will send my network members who qualified to apply. So, thank you, Jules. Also, I did put a link to a survey in the chat. Feel free to take a moment. Thank you, Joel. My apologies. He, him. Roosevelt, maybe one or two things that you want to leave the audience with today. I mean, again, I want to acknowledge Jewel had mentioned that this was a master class in corporate governance. I couldn't agree more. Anything you want to leave the audience with? One or two things?
Well, all I have to say is that those who are seeking board seats, you know, this is a marathon, not a sprint. It's what
Mm.
it's not. Um, and but you got a lot of advocates around the activist investors and the index funds and everybody else that are working to make this happen. You know, for boards. And one of the things we have to do is that go to the Conscious Capital sessions on uh, the programs that we have, in addition to the other chapters around the country, and get a firsthand feel and touch as to what that means and how your organization can be a part of this movement. Also, with Just Capital, engaging with Just Capital to help your organization to do a wellness study initiative that can help bridge that relationship between management and the employees. Because the only way this is going to work, okay, is that we have to all work together, because we the
Indeed.
people is broken, okay? We the
Mm.
people is broken. And so I believe that capitalism can be used as a bridge to bring we the people together. It's what I
Mm.
can believe. So
Indeed.
thanks a lot. Appreciate it.
Yeah. Thank you, Roosevelt. I just want to also, I put a link in. Roosevelt's going to be one of our keynote speakers at our CEO Summit in Austin. So if you qualify for that, I put a link into the chat. And then lastly, the Dallas chapter, Roosevelt mentioned we do have a vibrant network of conscious capitalist chapters throughout the country. They are having an annual event in early May. So I'll just, as a last call to action, just put that in the chat as well. Roosevelt cannot wait for an opportunity to connect with you in person in October. And again,
Well, I'll be
thank
at
you.
the meeting again. I'll be at the meeting in May.
Okay.
And yeah, I'll be
Oh,
there.
wonderful.
And
Wonderful.
again, those who are on the still on the session, as Michael stated, we're having our CEO summit in October in Austin, Texas. If you have $5 million in revenue and things there, I think that it will be an investment that you would want to repeat year after year, to be around peers in different industries and things, and to understand you know, what's going on in their world versus your world. So wonderful, fantastic organization that's trying to help companies be their best selves while making their people their best selves as well.
Mm-hmm.
So happy hunting on those that are looking for boards, and those who own the boards. You know, please advocate for getting your boards to put up an advisory board slot, and also to bring on the necessary skill sets to keep these companies alive versus being going out of business or merged or sold. So,
Wonderful. Well, on that, Roosevelt, again, thank you so much for your insights and your masterclass on corporate governance. And thank you to all the attendees for joining us today. Greatly appreciate you spending the hour with us. Wishing everyone a
all right.
fantastic
Thanks, everybody.
rest of your day.
All righty.
Take
Bye-bye.
care.